On behalf of Carnegie India and my colleagues, I welcome you all to this discussion on the Fintech disruption. Last year, when we decided to launch our Technology Forum initiative, we were clear in our own mind that technological transformation of domains, whether it's finance, healthcare, transportation, or governance, and its conflict with regulation, is now a recurrent theme in Indian policy making and is here to stay. At the Global Tech Summit, which we did in Bangalore last year, the first activity which we did as part of the Tech Forum, we heard a multitude of voices across the spectrum who confirmed this belief. Automation of jobs, Internet of Things, quantum computing, Hyperloop. While all of these sounded a bit far from reality, instinctively we knew that they are knocking at our doors with varying levels of intensity. So it is around the same time that India had already witnessed a hard month of demonetization and long queues, cashless, less cash, all these were expressions being used with greater. It was truly fascinating for all of us to listen to Mr. Nandan Nilekani at the summit. He lucidly explained the changing incentive structures in the banking and finance sector, compelling us to think more deeply about technology and regulation, and in some ways convincing us that the first deep dive that we do post the summit has to be fintech regulations and policies. Of course, a big challenge posed here is the definitional challenge. What do you mean when you say fintech? For starters, there is fintech that is accessible and known to the common man, such as digital wallets, other payment services, Bheem, UPI, Aadhaar Pay, net banking. And then there is also fintech which operates at the back end, making financial operations probably easier, quicker, more reliable, etc., such as blockchain, big data solutions, robo-advisory. Again, at this point, as luck would have it, the Wattle Committee report had just come out, and that's been a great guide in helping us both mapping the space and identifying some of the diverse concerns posed by fintech. And the report particularly focused on payment systems, but also did place the spotlight on several possibilities for the future. We decided that a good way to begin our research would be a discussion in the presence of and between various stakeholders, as we are doing today, on two major aspects of financial technology. One is digital payments, and the other is efficient solutions which go beyond the here and now of transactions. We realize indeed that this can be no strict division, considering the capability of the future to always subsume the present when it comes to technology. But we have broadly separated the two panel discussions here on this basis today. No research can possibly begin without the right set of questions. Our initial reading of the literature flagged some of them, which I would just present here quickly. Are there sufficient incentives in India to go digital and enough disincentives against the use of cash? Is the last mile reach inclusive enough, and what more needs to be done in this direction? Does the regulatory framework in India promote or hinder innovation in the fintech space? Is the digital payments ecosystem safe and secure? And do our fintech companies respect individual privacy and data protection standards? Are there sufficient checks on the government, which continues pushing for Aadhaar-centric eKYC as the centerpiece of many things, including financial inclusion, to respect such values? Are citizens equipped with optimal levels of financial literacy? And finally, the question that is perhaps most integral to our research agenda, considering our belief in the immense potential of innovation to resolve many problems, are startups and innovators in India provided the right set of policy incentives to innovate in the fintech space, or do they face entry and operational barriers? We are confident of coming up with many new questions, nuances to the presently stated ones, as well as some preliminary answers by the end of today's panel discussions. And the reason for that exists in this very room, all of you. Thank you once again for taking time out to be present here. We therefore want our panel discussions to be interactive, because we know that there are multiple views out here waiting to be spoken out. Our eminent chairs for the day, Mr. Probir Roy and Mr. Bala Parthasarathi, have structured the discussions with this objective of ours in mind. Once the panelists in each panel speak briefly about their respective themes, the floor shall be made open for questions, comments, and observations. For us, this is only a beginning, as we aim to follow up with several interviews and a detailed report on fintech regulations aimed for end August. At the heart of all these discussions lies the very future of finance. Are we moving to a world where traditional currencies and currency systems will be compelled to coexist with newer value storage mechanisms and decentralized regulatory power? Will the banks of tomorrow be drastically different from those today? Indeed, will there be banks, lending entities, or credit rating agencies at all tomorrow? Or will they all be technology companies of some kind or the other? To address some of these themes, we have three eminent speakers for our opening section, Mr. Amitabh Kant, Dr. Subir Gokarn, and Mr. A.P. Hota. I now call upon my colleague and our Managing Director, Mr. Shivnath Thukral, to introduce our keynote speakers. Thanks.
Thanks, Ananth. Is it okay if I do it? Okay. Hi, my name is Shivnath, as Ananth said, and since Ananth didn't introduce himself, that's Ananth Padmanabhan, who's our fellow at Carnegie India. He looks at technology and policy as a work stream that Carnegie India has been pursuing since last year, and we did successfully host the technology forum in December in Bangalore, and I'm glad to see a lot of the Bangalore players have come into Delhi today to talk policy, and so have some of the Bombay players, and so have some of the Delhi players. So as Ananth summarized, our aim is to get all the stakeholders in the same room on the same platform to have a discussion, and we couldn't have a better panel to kick it off than the one which is seated next to me. I don't think they need any introduction to those who are in this room, because if you're in this room in this industry and if you don't know who they are, then there's a problem. Without wasting much time, just a couple of hygiene issues which I wanted to flag off, because we usually like to do our entire session in an intense manner, so there is no break till the last panel. If you need a bio break, please feel free to go out and come back in. The tea will be served at around 3:30, which will be a rolling tea, so we won't interrupt any of the session. We'll just go back to back till 5 o'clock. So just to let you know, yes, the idea is to come up with some hardcore ideas, some more thinking as to what's going on in this very, very confusing field as far as I'm concerned, because there is just way too much happening. And to make sense, I must compliment Mr. Hota and Mr. Kant as to how they make sense and still continue making regulations. But Mr. Kant is well known to give the larger vision as to why India needs this. And I think he's been on record to say that how post-demonetization, the whole advancement by almost 3 years of digital inclusion is something that we need to think and discuss about. But at the same time, with Mr. Hota here, it's a tricky play for him. In a way, he's owned by many people, his organization. He has to be the neutral player, yet he has to be a player. So there are many facets to his functioning which he has to distance himself from in the near future, maybe, or maybe not, as the Wattle Committee said. So there are things that we need to all sit and discuss. Dr. Gokarn, who I've known for a long time, he's a very, very reputed economist. I met him first when he was at NCAR, but ever since he's been on the think tank side as well at Brookings, as a so-called rival organization, but we don't care. He's highly reputed, and he was in town, so we kind of took the advantage of inviting him to do this. So without wasting much time, Mr. Kant, the floor is yours. You want to hear, actually, yeah, he wanted to hear Subir first, so Dr. Gokarn, you want to go first? But I hope you're not listening and going away.
Thank you, Shivnath. Thank you, Ananth. Thank you, Probir, for inviting me to share my thoughts at this event. As Shivnath said, they took advantage of the fact that I was in India, so I did not get the customary first-class airfare from Washington that Carnegie is reputed for. I hope at some point in the future.
We would go bankrupt if we did that.
I will get that, not to mention the presidential suite at the Taj Mansingh, but that's another story. I got the program with 5 words in the title, and I was told cover all of them. I figured that would be about a 2-hour discussion, so I took 2, and I hope to do this in about 15 minutes. But I think the excitement and the sort of energy and the intensity of the debate on financial inclusion, particularly in the last few months, requires a little bit of distancing now, a little bit of stepping back and looking at the sector through perhaps somewhat traditional prisms. It's all very well to talk about newness and disruption and exponential growth and so on. And all of these are phenomena that many other industries in the past, many other sectors in the past have experienced. But I don't think we should lose sight of certain sort of core principles that apply to the activity of regulation. And so I'm trying here to persuade you that even as we are dealing with something that is fundamentally new, fundamentally different, brings a whole number of different elements into the financial sector, that we should not forget the basic principles, the building blocks of a regulatory framework. And then how do we balance out the benefits of disruption? We're using disruption here in a very positive way, a very creative and constructive way, with the, let's say, the anchoring role that regulation provides in this situation. So let me start by laying out a context, and I call it a context because I don't want to presume that it is the only context in which one can have this discussion. But as I said to begin with, regulation and disruption are actually contradictory, because when something is happening in industry or an activity is moving at such a frenzied pace, there's so many different models, alternative ways of packaging and delivery and communication and so on that are all vying for attention at the same time. It's a little difficult to visualize that somebody in the system actually knows what the hell is going on and can actually start framing rules to govern it. And so when we look at, say, for example, the Silicon Valley model, it would be very hard to visualize somebody actually regulating that space, even though there have been sort of arguments made that perhaps it's necessary. Regulation usually kicks in these industries, and one has the whole sort of telecom or technology-related sectors. When you see the emergence of dominance, when you start to see certain models starting to assert themselves over others, there is obsolescence, people go out of business, a few winners emerge and then start to exercise monopoly power, and then there's this clamor for regulation, so you have regulation, and often that actually tends to impede or slow down what would otherwise have been a very still a very dynamic, innovative process. There's an excellent book that tracks this in a variety of technology-related industries called The Master Switch. I would so recommend that. And what I think it says is essentially that there are certain common patterns to this process. Now, the question is, who can predict this? Can a bunch of people sitting in the national capital, the Treasury Department, or the NITI Aayog, or wherever it is, or the telecom department in this case, or the finance ministry, do they have the ability to predict? And I think we would all be very realistic in saying no, because this is newness. There are no precedents. There's no time series models that you can use to predict this. It's all exponential. It's all discontinuous, and that's why it's a disruption. So the imposition of a regulatory framework prematurely on this emerging space really is constrained by these two very mainstream economic concepts, which is imperfect information. Nobody quite knows which model is going to emerge, and weak foresight. You just cannot predict the trajectory of this. There's so many things that are going to shape this. And so it might hurt. Regulation might actually hurt, because it might actually prevent what will eventually be the most efficient models from emerging. So I think this is a fairly strong case for, like, let's wait till things settle, let's wait till things stabilize. Don't impede the innovation process. There'll be losers, no question. Companies will shut down, investors will get hurt, but those are the risks that they understand, those are the risks that they take, and there's no reason why anybody should stop this process. There's no public policy motivation to come in the way of this process, and that's really the sort of characterizing the Silicon Valley kind of model. companies shut down, but people don't get hurt. Those skills are easily transferable. They move to other businesses and so on. But I would make the case that finance may be an exception to this laissez-faire kind of approach. Not to say that the imperfect information and weak foresight caveats do not hold for finance. As we are looking at our own landscape today, as we're looking at the number of different models of delivery that have emerged, the number of different players who have brought from their own domains skills, capabilities, institutions, and resources into the picture, it is very difficult to argue that we know which of these is going to win. And when we look at, for example, the payments bank space, which we know, the licenses, 11 licenses issued into 2014, I guess, 2015. They came from such diverse backgrounds. They came from the telecom sector, they came from the prepaid instrument sector, they came from microfinance, they came from there was just no single dominant mode of or basis of entry, and that was, I think, the best possible outcome. It was a race. You brought several different capabilities, and maybe one or more of these would win. I'm not getting into a discussion on the merits or demerits of payments banks. The last time I was in this room, Krishnan and I were hosting a seminar that was discussing exactly that. That's another story. But I think when we look at finance more generically as to what financial sector does, we should not lose sight of the basic motivations for regulating finance in the first place. And those are the four, I'd say, building blocks of financial regulation, which, whether we're talking about traditional banking systems or investment banks or stockbrokers or insurance companies or whatever they are, all of whom are different or providers of different financial services, that these four principles really don't go away. And they certainly apply to what we're going to see emerging in this fintech-driven space. Ultimately, fintech is a combination of new models of production and delivery and the adaptation of old institutions to these new ways of doing business. So I think the point that Ananth made in his introduction, are these banks or are they non-banking companies and so on, that they ultimately are all technology companies now. They cannot survive without having achieved a very high threshold, I think, of technological assimilation. And that is a reasonable way to look at them. They're all tech companies. They're tech companies doing banking or tech companies doing insurance. But ultimately, the core of their competence, or the source of their competence, is their control over technology, combined with other capabilities, of course. So these four elements, I think, have to be kept in mind, have to be shaping thinking on regulation of the new fintech environment. One is that finance offers deferred gratification or deferred consumption. So you're taking a risk. You're giving somebody your money with the expectation that there will be return in the future. That's not the same as buying a television set, or perhaps a television set you're still worried about warranties and so on, quality. But a consumable is immediate gratification. This is deferred gratification. Risk management is very critical, because what is done with the money that you give this person matters for your return. The person may use it to do things that ultimately do not allow him to pay you what he owes you. So that's the traditional microprudential regulation that we are familiar with in the banking space and some other spaces. More recent entrant into the debate on regulation is financial stability, also referred to as, or from a regulatory perspective, as macroprudential regulation, which looks at system integrity, the ability of the financial system as a whole to withstand shocks without reneging on its commitments. Of course, it's a little difficult to think in terms of what is happening now at an entry level, lots and lots of relatively small players coming into space, to think in terms of system implications. How do they impact the system? But I also want to make the point that regulating by reverse engineering, retrofitting regulation, is a huge problem. So if you're looking at a trajectory, I think it's important to build into the process anticipation that some of these models will emerge as large players with systemic implications or systemic the ability to disrupt systems in the event of failure. So one has to be a little forward-looking in considering financial stability as an issue in regulatory design, even at this very early stage in this game. And finally, the network characteristics of finance, the ability, like in a telecom space, interoperability is absolutely critical to the viability of all telecom operators. Similarly, in a multiplayer financial environment, closed user groups and so on are actually very inimical to viability. If you have cash, it is universally acceptable. You can take the 500 rupee note and have no fear that it will not be accepted in any transaction that you engage in. If you're looking at cash alternatives, then that same level of universality should be there, money moving across different systems, purchasing power, if you will, moving across different systems, ability to pay from any provider to any other provider. All of these, I think, are important exploitations, benefits that come from network characteristics of the payment system and need to be kept in mind. So these are the four, let's say, regulatory building blocks. Let me apply them now to the sort of more specific discussion of financial inclusion. We are often tempted into thinking of financial inclusion as something that is being done for people who are as yet out of the system. They don't have access to basic financial services. And that's, I think, a reasonable starting point. Let's get the first steps in motion. But when we think of financial inclusion as a long-term process, let's not confine our thinking to low-income households or people who don't have access to banks. Financial inclusion, I think, more broadly defined and more effectively defined, basically means that people should be able to, anybody should be able to get any financial service that is on the table, that is available, at a reasonable price, whatever conditionalities apply. But we have to, I think, move a little bit out of this basic bank account kind of thinking and into what I would like to call the 3P framework. This is something that I take some credit for because I wrote about it a couple of years ago, or you wrote a piece using this framework. And the 3Ps are pipeline, product, and perception. And you can actually break this up very neatly into very concrete examples. You have the opening of bank accounts, for example, whether it was done through the pre-Jan Dhan period, the post-Jan Dhan period, the introduction of payment banks, of small finance banks. All of these are essentially creating pipelines. They allow individuals to occupy one end of a pipeline, which plugs them into everybody else who's also at some end of the pipeline. And that is very, very significant. Mr. Hota's organization is actually, in a sense, a hub for that pipeline, for that network of pipelines. And it allows then the movement of money across from any individual to any other individual for any legitimate purpose. Product is what flows through the pipeline. And I think we started off thinking of product as a savings account, but we moved beyond that. We moved to, I think, 4 basic attributes. There is a savings product, there is a credit product, there is an insurance product, and there's a pension product. We have, in the last 2 years, started to think about product delivery in that format, 4 basic financial needs and different schemes that have been put in place in order to deliver them. But then each product must have some characteristics that make it viable. Ultimately, a product that is not viable is not going to float. And if you're talking about disruption and churn, what has to emerge from that disruption is a set of viable, financially sustainable products. And the third element is perception, which is the extent to which consumers, the beneficiaries of this entire initiative, actually trust the system. Do they believe that it is something that they can use? Are they worried about where their money goes when they entrust the system with it? Or can they sort of go to sleep comfortably, assured that there are enough checks and balances, safety nets, safety valves in the system that ensure that their money is safe? And each component then, if you break it up in this fashion, has a different set of regulatory implications. So if I were to go through a full exercise here, I would be drawing a matrix with the P's on one axis and regulatory implications on the other, and each box would then have some content or no content. Some boxes may remain empty. I'm not going to do that. That would take up too much time and bore, I think, most people. But this is a set of illustrative, entries, if you will, in that matrix. The pipeline, I think, is relatively easy to put into a regulatory framework. It is, as with any network system, it is a critical hub. This would be sort of the equivalent of a transmission system in the power sector, or the fixed line, the railway track in a transport system. It is a hub. It is how everybody accesses everybody else. Everybody else is the spoke. And it has intrinsic monopoly characteristics. So when it has monopoly characteristics, it's important then to exploit those economies of scale and other advantages that come with it. And so we have two options. The option we have here is largely a public ownership option, which is how utilities are owned in many countries. Or we have a monopoly regulation option. It can be a private enterprise, but it would be subject to regulation. I don't think we have the basis to decide which system is superior. Ultimately, the test of this is whether it is offering its network services efficiently or not. But the key requirement for this is open access. The key requirement for this is anybody who is eligible to offer a financial service, which is determined by some process separate from this, must have absolutely unfettered access to the system. The minute you bar access, the minute you limit access, you are not exploiting the benefits that could come from innovation, from the disruption that we're all talking about. And this is, for example, the open access conditions we have in our grid now. That's a lot of debate, a lot of back and forth on what is the right amount of access. And ultimately, I think most people accept the argument that unless you have the ability to transport power from any producer anywhere in the country to any buyer anywhere else in the country, you're not getting the full benefits of the system. The same thing was done in the Euro Rail, where each country, each member of the union, has the right to impose certain restrictions on the operational aspects of railway services. But every country has to offer every other country's trains completely unfettered access. So if you board a train in Germany, for example, it will take you to anywhere in France or anywhere in Italy, just as much as an Italian or French train can take people into Germany and so on. So that's, I think, a very, very strong and very important dimension of this. And of course, to perform these services effectively, system security is of critical importance. So how efficient can you be, but without compromising on safety is a sort of regulatory concern that has to be addressed. On the product side, the key traditional elements, if you will, of regulation are customer protection. I, even now, despite having put myself on a do not call registry, I think about 6 or 7 years ago, still get calls every few hours offering me some financial product or the other. And I think the way these products are marketed, there are concerns. Now, this will become, I think, even more difficult to deal with when you have a large number of players eager to enter the field, finding innovative ways of packaging and selling. And so transparency and disclosure are absolutely critical requirements. These are absolutely traditional building blocks of financial regulation in a historical sense, and I don't think their importance diminishes in any way. In fact, it increases. Its importance increases as we move into a more, about 4 or 5 minutes. And we need escape clauses. We need consumers have the right to, must have the right to exit when their assessments change. So lock-ins and so on need to be controlled. The second aspect of product regulation is risk management. Again, this is very traditional financial regulation, but it applies equally importantly to new business models, new providers. I don't have a list of instruments that are appropriate, but I think the objectives are quite well known. And finally, seamless regulatory coverage. Different products in most frameworks are covered by different regulators. But the sort of risk of falling through the cracks, neither here nor there, is a risk, and so regulatory coordination is important. On the perception side, despite the misgivings we may have about licensing, there is some merit for it. I, for example, have come across situations where financial companies put up a board saying, licensed by the Reserve Bank of India without actually having gone through the process. And apparently that is a very strong pull. People just believe that because that board is there, it's safe putting money. So somewhere licensing and enforcement are of critical importance. System safety nets like deposit insurance add value. This is traditional for banking. How do you extend this to other modes of financial service delivery are a question. Speed of resolution of failed providers is a huge trust building element. And interconnectedness goes back to the point I was making, that if you have put your money in a particular institution or you have dealings with a particular institution, you must be comfortable that it actually allows you to do exactly what a wad of cash would allow you to do. Otherwise, you're always going to prefer cash to the system. So those are the 4 elements of perception. So let me conclude with these 5 key messages. They're not the only messages that I'd like to take from this, but just to keep the list a bit short. I think I would accept that disruptive processes are not generally amenable to regulation, and so we should be very careful about how we regulate them. But there are also high social costs to getting it wrong, and that's not something we want to be doing, getting ourselves into a situation where things have evolved to a point where they just become unviable, and there's a massive meltdown which is in nobody's interest. I want to assert the point that finance has unique characteristics, and therefore even in a disruptive state, regulation is warranted. And to do that, we have to, I think, go back to the building blocks that financial regulation is based on. Those are still relevant, those are still useful, they need to be perhaps tweaked or innovated around. And ultimately, it's this modularization that is going to give us answers. How do we break up the whole strategy into different elements? How do we attach or associate different regulatory instruments to each of these elements? Does it add up to a neat, clean regulatory framework? Probably not. We never have neat, clean regulatory frameworks. They all have their edges. But I think I hope that is this kind of thinking that is going to shape our regulatory movement. Thank you.
Thanks, Dr. Gokarn. Thanks for kicking it off. Amitabh, Kant next. You want to go to the lectern?
Thanks, Subir, for that very fascinating presentation. Let me first compliment Carnegie for this initiative and putting all the people together. We are undoubtedly in the midst of a very major technological disruption. And this sector will be very, very difficult to regulate. Particularly if you look at the vast amount of radical changes that have taken place in the last couple of months. And if you look at post-demonetization especially, we have a non-cash transactions today of just 22% of all consumer payments. There are very severe barriers for consumers to go digital. One is that cash is very much embedded in the blood of Indians. We love cash, and there has been in the past a complexity of digital payment instruments. There have been issues of payment gateway pages not available in regional languages. There's been limited reach of the net. And of course, there have been issues of hidden charges, fraud risks, trust issues, and so on. But my view is that in the next 4 years, digital payments will overtake cash transactions by about, let's say, by 2017, in the next 5 years, by 2022, you will see digital payments overtaking cash transactions. And this will happen simply because of the vast number of technological and radical changes which will be brought in. The extent of technological disruption will be so enormous. We have a current value of digital payments of just about $50 billion US. But by 2020, we envisage that the total payments via digital instruments will go up to almost about 500 billion. We have taken a vast number of measures, but it's important to look at how low our usage is right now. It's important to look at these figures. The RuPay cards used at POS and e-commerce is just about 16 lakhs per day. The USSD transaction, that is *99#, is just 1,300 per day, only 1,300 per day. The Aadhaar-enabled transactions at micro ATMs are just about 12 lakhs per day. The UPI, transactions are about close to 50,000 per day. E-wallet transactions are about 63 lakhs per day. And merchant POS transactions are about 98 lakhs per day. But why is this going to change so radically? And it's going to change radically because one is that you've seen in the last few months a vast number of technological disruptions taking place. First of all, I would like to compliment Mr. Hota and his team at NPCI for having created an interoperable system which is extremely sound and extremely efficient. We've seen the emergence of Bheem with about 20 million downloads. We've seen the emergence of QR code initiative by the debit card by Visa, Master, Amex, everyone together. And just the other day, Samsung Pay has launched Samsung Pay, which is a very neat app. It's got debit card, credit cards, it's got API, it's got UPI, it's got wallets, everything. And you just need to put the Samsung phone on top of the POS machine and your transaction goes boom. So you are going to see a huge amount of technological innovation taking place, and most of it is going to be driven by the private sector. And the technological innovation will be at such a rapid pace that you almost on a fortnightly basis you'll see technological innovation driving digital payment. That's number one. Number two, we are moving from a regime of low volume, high transaction costs to high volume, low transaction costs. And therefore, you will see reduction of MDR, you will see cashback, you will see referral schemes. Many of them will be pushed, and cashback referral schemes are even going to be pushed. The budget has announced it for Bheem, cashback and referrals. So even government is pushing for cashback and referrals. And therefore, you will see a lot of initiated fiscal incentives to drive behavioral change towards adopting digital payments. And you've seen IDFC's new ad on Aadhaar Pay. Many of you would have seen. It's running on television channels, actually. And government has been running Bhim jingles and Bhim ads and so on. So there's extensive mass communication campaign taken up not merely by governments but by the private sector to educate people, merchants about methods and benefits of cashless payments. And thirdly, I think simply because UPI is an extremely seamless, interoperable and universal payment interface, which makes things extremely simple and easy. The KYC on relaxation on there's been a KYC relaxation on transactions up to rupees 20,000 per month on prepaid instruments. There's an exemption from two-factor authentication in case of wallet transactions. The Aadhaar linking makes KYC easier and faster. And then there is, of course, the Bharat Bill Payment System, which launched in August, which allows multiple payment modes at merchants' POS. And as Subir had mentioned, there's also the licenses issued to 11 entities for payment banks. And Airtel, along with Kotak, Mahindra in Rajasthan, has done a phenomenal job of getting people simply on the basis of Aadhaar. And Reliance Jio, when it gets into its payment bank, will be a very, very, major disruptor in the sector. So you will see a huge amount of change which is going to take place. And my personal view is that Bhim, UPI, and this Aadhaar-enabled payment system is going to be a very major disruptor. The Aadhaar-enabled payment system is going to enable transaction to take place on the back of just your Aadhaar number and your thumb. And therefore, you don't need to remember your PIN, you just need to remember your Aadhaar number. It is very safe from frauds, etc., because you need either your iris or your thumb impression. And therefore, those of you who've transacted Aadhaar-enabled payment system or Aadhaar Pay on IDFC would realize how smooth and convenient it is. And we have actually, in the last couple of months after demonetization, really driven the fact that all the collectors in the country today have been made responsible for ensuring that bank accounts get converged and integrated with both the mobile phone numbers and with the Aadhaar numbers. So this is a huge, huge challenge which the government took upon itself after the Jam Trinity. This huge movement which was initially taken to open about 276 million bank accounts across the country. But now the second drive is really to ensure that everybody's bank accounts has both the mobile number and the Aadhaar number. Now if you have 110, if you have 1 billion plus biometrics, and India is the only country with 1 billion plus biometrics, and India is the only country with 1 billion plus mobile. There's no country in the world which has this. So the government strategy is that 450 million Indians who have a smartphone are able to use their smartphones and do transaction through, you can use your smartphone to do all your transaction, whether it's a wallet, whether it's your Bhim app, whether it's your UPI. So a smartphone, a person possessing a smartphone, for him the mobile is both the bank and the wallet. And therefore the age of physical banks is almost dead. The cost of establishing physical banks is totally dead. It's so expensive today to create a physical bank that it's a dead concept. It's going to be a dead concept in future. Nobody is going to set up physical banks in rural areas. And therefore you'll have 450 million Indians who are going to use smartphones to transact. And therefore the mobile will become your bank and your wallet. The next 300 million people who have the GSM phone, they will transact using the GSM phone through *99#, through *99#. And that's low amount of transaction, but that becomes very easy for them to do *99#. And Bheem has this facility of USSD *99#. But there are also in India about 250 to 300 million people who don't have a mobile. Don't have a mobile. And therefore, the model will be that if you go to Krishna and Godavari district of Andhra today, or if you go to some of these villages of Jharkhand, the ration shop dealer has the POS machine, on which the POS machine is also linked to weighing, also serves as a weighing machine, and therefore it also weighs your ration card. It also weighs your ration. But he's also the banking correspondent. The ration shop dealer is also the banking correspondent, and he does cash in, cash out using that POS machine for all the people who come for their ration. And all the people who come for their ration, they get all their money from this ration shop dealer, and boom, he does the debit for them from their bank account. So using the POS and using Aadhaar, the Aadhaar has become the means of empowerment, and therefore all of them are transacting, doing cash in, cash out using their Aadhaar. And this movement is going to spread across the country for the balance 200 to 250 million, 300 million odd Indians who do not have mobile phone. They will all be linked to either ration shop dealers or the service centers, the CSEs of the Ministry of Information and Technology, and they will do cash in, cash out for them using the POS machine and using Aadhaar. So therefore, the strategy is to link up everyone either through a smartphone, GSM phone, or through POS machines. But in the long run, every single mobile made in India will be either having the dongle on which you can use your thumb impression or your iris. As today it's happening with Samsung, and our intention is that mobiles being manufactured in India, and we've seen about close to 50 big manufacturers in the last 2.5 years manufacturing in India, all of them ensuring that there is either the facility of the thumb impression dongle or having the iris facility in India. So every mobile will have that facility. And actually every mobile in India will become a walking ATM. Every mobile in India will be a walking ATM for everybody to move around and do transaction. And to my mind, this will be the biggest revolution. India is in the midst of one of the biggest disruptions taking place in the history of the world. India is in the midst of one of the most radical disruptions which will ever take place, where technology will ensure that people transact through Aadhaar on their mobile, and mobile becoming the bank and the wallet. And eventually over a period of time, over a long period of time, we'll all forget debit card, credit card, ATMs, POS machine, and Indians will only be transacting through Aadhaar. It'll be so easy and simple that we will be in the midst of a very, very huge technological revolution. And what we need to do is not to say that you do away with debit card, credit card, but to ensure that all of them also keep innovating. Like they've done. They've brought in the QR code, which is interoperable. So the challenge is that we encourage every single player from the private sector to challenge every other mechanism. Because after all, we have different modes of electrical and digital payment. We have RTGS, the real-time gross settlement. We have NEFT, the National Electronic Funds Transfer. We have the immediate payment system. We have the National Automated Clearing House. We have the UPI. We have the USSD. We have the Bheem. We have POS machines. We have debit card, credit cards, mobile banking, PPI, prepaid instruments, debit card, credit cards. We have Aadhaar-enabled payment system, and now the Aadhaar Pay. And the number of new young people I've met who've come in with such revolutionary changes, young startups who came to me on linking up through voice mechanism on making two mobile phones talk to each other, you can do all transactions. So in the future, you will see a huge amount of innovation taking place by young startups who will disrupt the mechanism again and again and again. And actually, India will become one of the most disruptionist society because existing players will be challenged by Aadhaar, and Aadhaar will subsequently get challenged by several startups, and India will be in the midst of a very revolutionary phase of financial technological revolution, which will lead to a great amount of financial inclusion, because all this will ensure that we are not dependent on bankers to give credit, which is the biggest nightmare. Your transactions will give your credit history, and that will ensure that you, on the basis of simply your past transactions, you are able to get loans in a very smooth, easy manner. And young Indians, farmers, people living below the poverty line, who are the best innovators, the best entrepreneurs, actually don't have to suffer at the hand of running from one bureaucrat to the other, one banker to the other, but are able to prosper simply on the basis of their past track record and their history. Thank you very much, ladies and gentlemen.
Thank you, Mr. Kant, for that spirited speech. I don't know whether, if I were a banker in this room, I would be a little worried. But I do have a couple of young startups that I know. I have PhonePe here, the founder of PhonePe. I have somebody who founded Citrus, so I'm sure they are quite excited listening to you about what you have to say. We have some seasoned players as well who will be talking on the panel very soon. We have Pramod, Prabir, and Bala be talking about that as well. So clearly, this is just the tip of the iceberg from whatever you're saying. But in the middle of the iceberg, you've thrown in Mr. Hota, who has to now navigate between many glaciers. Mr. Hota, the floor is yours, and of course, yes. Please let us know how you will navigate this.
Right. Thank Mr. Shivnath ji and Mr. Padmanabhan for asking me to join this very eminent panel. It is a great honor to be to join the panel of my former Deputy Governor and Mr. Amitabh Kant. I'm basically a payments person, so my observations would be again based on payments. Many of these things have already been covered by Mr. Kant, so at the cost of repetition, I will tell a couple of things, but some of the suggestions I can really put forth to this audience. I would also really put forth a few suggestions. In the fintech, the way I see it is the use of cutting-edge technology in financial services. Basically, the way I see many fintech companies, either they are operating in the payment system space, or in the analytics, or in risk management, or P2P lending. So let me not really, I do not have the depth in the P2P lending really in that space, so I would not go venture into that. And so far as the risk management and security concern related services which the fintech companies are bringing out, I will also not go into that. That requires a very technologists to be there to really to have a very meaningful interaction. And for the analytics part, really, I can really broadly really, the way I know, I can really share my thoughts. And in the payment systems, Mr. Amitabh Kant has really very eloquently already described the state of the payment system in India. You know, one of the best in the world. Maybe 10 years back, from the banking system, including Reserve Bank, used to go out to different countries, developed countries, and learn. Those days are gone. In fact, the banking system has come of its own, this payment system, and it is now really, you can say the payment systems in India is one of the best in the world. It has got, as I said, as Mr. Amitabh Kant has already described, it has got the money transfer system 24/7. With IMPS in place from 2010, any time in the day and night, money transfer is possible. The rails that NPCI has built now covers almost the entire banking industry, not only the main public sector banks, private banks, foreign banks, and the RRBs. Now the rails have covered even the state cooperative bank and the DCCBs and the urban cooperative banks. Leaving aside about 400, 500 urban cooperative banks which are still not computerized, or they are computerizing, or they are a single branch operations, nearly 1300 banks are part of NPCI network. So the customers having accounts with any of these banks, they are now connected real time 24/7. So connection is not a problem. Money transfer to really the customers in any part of the country is not a problem. Now even the prepaid issuers of the 35, 36 licenses that have been issued, and about 22 are already operational in the country, they are all connected to NPCI system. It is a point of really, it's just a matter of time and maybe a matter of a couple of months that Reserve Bank is thinking even the prepaid issuers also to be made interoperable. So if prepaid issuers are interoperable, banking system is as it is interoperable, interoperability is really has happened. ATMs are fully interoperable, POS interoperable. So interoperability has already happened. Now the question of really having this state of the affair, now if the fintech companies would like to really offer services that the customers want, and they would like to offer services which banks cannot do, because banks either it is they are costly or they do not have the bandwidth, but the fintech companies or the startup companies, because with the low cost structure, they can come out with very good services. What they want is the customer information. Whether the customer information they can get from the banks through the APIs. So API based, the way the current structure the country is, if the fintech companies would like to really do some services, they will have to really go from bank to bank, this bank, that bank. They will have to approach 10 banks to really get really any kind of meaningful services. They can do that. Can they really do through the APIs if the customer consent is given? Like in Europe, the PSD2 really, which is getting kicked up from 1st of January 2018, that if customer gives the mandate, then even the fintech companies or anyone can access information about the customer and the services can be given. Example is really if a person walks into really Bijaya sales and he would like to buy a fridge, and he says really I would like to really do this thing, and Bijaya sales has got a scheme that it will really do the EMI, and they would like to know about the customer, and customer says you can check my balance in the bank. Bijaya sales cannot really trigger a message and get the balance about the customer. The customer really, only thing that he can say, you tell me your balance, the bank balance. He says, I have got bank balance. It has to trust. Now in the revised scenario, suppose in the PSD2 kind of scenario, if the customer gives the consent, the data has to come about the customer information. After all, customer is giving the consent. The regime of consent is there. So if the regime of consent permits the customer data to be shared, it should be shared. So that kind of regulation has not come into India. Is it that what really even the fintech companies in India want it? I suppose it has not been voiced anywhere. That we would like a regime of APIs where customer gives the consent and we would like to provide the services. That has not come. After all, really, now a Reserve Bank had set up a committee with Mr. Sudarshan Sen as the chairman, and I happened to be a member there. The kind of discussions that was there, as if really the requirement is in the industry is not there. The fintech companies, they are doing on their own way. So what the fintech companies want from the banking industry, it has not been articulated. Maybe AI, MAI, quite a few institutions, they are really formulating the viewpoint. But the viewpoint would have to be formulated that in the fintech kind of thing, what is it that require? Sumoto Reserve Bank has said, going by the examples by a few countries, that we will really give a regulatory sandbox will create, whereby really the banks would be willing to participate, they will be willing to share data, the fintech companies will like to come and they would like to really say, we need this data from the banking system and we would like to experiment, be it in the area of different kind of new financial services or in the analytics or in risk management, and we would like to do that. So one regulatory sandbox is in the way, and that is in the part of the committee's recommendation. I suppose the committee has just completed the work. Anytime the report is expected. So a regulatory sandbox in the fintech is coming. So possibly it is the time to really, that will be an interface where banks and the fintech companies can possibly have a dialogue, like a constant dialogue in a quarterly basis. The Monetary Authority of Singapore organizes with fintech companies and the banks, and asking banks, you tell, what do you want from the fintech industry? What problem of yours you would like to be solved by the technology companies? In good old days, like, going by this thing, the banks wanted computerization. The core banking solution. They called Infosys, TCS, Wipro, you come and really, you just help us in computerizing. And they computerized. We don't call Infosys or Fintech as the, Infosys as a Fintech company. They have really grown so big. But possibly had there been no computerization, possibly we would have been calling them a Fintech company. But now, what is the financial services cutting edge technology that they would like? Just really a week back, one company from Pune came to us, to NPCI. He made a presentation and that he said, I have developed a portal whereby the people who have let their houses on rent, they will log in, they will give the details, and people who have been staying as tenants, they will give the consent, and first of the month I will see to it that all the people really, the house owners, they get the money, the tenants, it is my responsibility to collect, the collection is possible. I have also services, any school can really log in, plug into my system, the school fees I will collect. I will collect the university's different kind of fees. Fee collection, even the club can really plug into my system and collect the fees. What you want is, I want an access to NPCI system. You give me a permission, I will plug in. And I will see to it that, then we said that really NPCI is the clearing house. Our members are members. Then he started, the person really, the company say, sir, after all, I'm not really touching. I'm not taking money in my books. My system will go and with the help of NPCI, debit the tenant's account and credit the owner's account. No point of time the money is into my account. The same way the school fees, from the parent's account it will go and it will really go into the school account. You give me access. Then really again the 3P framework of our deputy governor, the pipeline comes. Can we give the access? Possibly we cannot really give the access. How can the access be given in a controlled way? Again, regulatory sandbox. Regulatory sandbox. You create the regulatory sandbox, you do the testing, how it works, how the school and college fee collections. My banker's friend will say, no, you cannot do that. We are the bankers. We are the banker to the colleges, schools and colleges. We will really collect the fees and we will give it to the banks, to the schools and colleges. It is our responsibility. Why are they not coming? No bank is ready with a solution which give at the end of the day or end of the week a very good reconciliation statement. Banks are in the process. I am pretty sure they are banks in the process. Quite a few companies are ready with the solution. University campus solution. But campus solution cannot be plugged with the payments because the certain rigidities are involved. During the demonetization period, really many microfinance institutions, they faced a lot of problems because normally they used to really make the payment by way of cash. Now cash is not there. So what are the alternatives to cash? We would like to really, in fact, they came out with various measures. All that we can say is you have to come through the bank. Through the pipeline that we have, nationwide pipeline and platform that we have built, you have to come with that. Our role is that. In fact, our specialty is that we are a platform company. We are a platform we do. It is the service providers are the banks. So you will have to plug into the banks and really start working. Would the fintech come out with solutions? So in fact, the kind of, even after building the rails, it is only, we have built only the highways. There are roads to be built, streets to be built, narrow lanes to be built, which the fintech companies would like to do. But if the fintech companies, all the small lanes would like to go directly into the highways, there are challenges. So the fintech would really like to really do the big in the matter of time, matter of maturity. And I do not think, personally, I do not think that with my interface, because now I'm, for last 7 years, I'm out of regulation. I'm not in the regulatory body. I'm in the processor. I'm a platform company and not for profit platform company. Yeah, but regulator, I believe, is quite positive. It is the fintech industry who have to come out with very specific suggestions, what they want, that we want this. I suppose with the regulatory sandbox which is coming up, really that can provide a bit of a solution. So with this, really, I would like to really end it here, and I would like to listen more of these things, because many of the things Mr. Amitabh Kant has already covered. In fact, in the payment system space is just really growing leaps and bounds. But the way it is there, the transactions have to be have to grow and grow. Even now, really, personal consumption expenditure on a digital platform is hardly about 6 to 7%. The mobile payment system, which we have been working, Mr. Pravir Roy knows really right from 2007. He has been a player, longest player in the mobile payment industry. The work has been going on, but still many things to be done. Hardly possibly what we have done is the tip of the iceberg. Lot of things can be done. The only 8% of the personal consumption expenditure is digital. If we want to really digitize and bring cutting edge technology in the payments, sky is the limit. So much can be done. That's all I would like to say, and really I would like to be here and interact, and I would like to listen. Thank you very much.
Thank you so much, Mr. Hota, and for that insightful commentary. And as you said, the idea is the fintech players will have to come up with suggestions and solutions, and we are hoping you find this discussion useful. So the way we will do it is we won't take Q&A now. We'll jump on to the next panel right away, Praveen, so that we absorb a little more discussion and then probably have a bit of an open house. So I'll hand it over to Praveen for the first panel, and I'll let Ananth do the introduction to everybody. Praveen, over to you.